Probability-based trading. How to think about it. We're going to be joined by a special guest today on Open Interest. Hello, everybody, and welcome. I'm Mike Coe. Welcome to Open Interest. Today, we're going to be joined again by Domenico Dall'Olio, who is an options trader, a quantitative researcher, and a lecturer on these topics in Italy. He has a couple slides for us, and we're going to hopefully delve a little bit more deeply into some of the topics that we touched upon in our first conversation. Dom, how are you? It's good to see you.
I'm very well this time. Thank you, Mike. It's very good to be back.
Yeah, I kind of remember you were a little bit under the weather the last time, so
I really
hopefully,
was.
hopefully the last month of summer in Europe, when I know that a lot of people are on vacation, has treated you well.
Yeah, absolutely. I had a week out of the office, so I could just relax and, do nothing for just a few days, and now I'm recharged again.
All right. Well, so let's just talk about some of the conventional approaches. So one of the things I wanted to touch on is that using the methods that you use and you promote, and also just talking about the Trade AI platform.
Mhm.
I think since the last time we spoke, it has become official. I don't believe it was true at the time that I was the yield max strategist at Title Financial Group, or we knew that it was going to be happening, but I don't think we had mentioned it yet. And this is particularly interesting to me because the yield max strategy of funds. So we run just under $20 billion in options-based ETFs that focus on selling options premium. There's a suite of single stock ETFs that basically sell covered calls. There are some that have a bearish tilt to them. And then we have some diversified funds. But obviously, for us as big options premium sellers, the kinds of things that you're looking at are, really, I think, important in terms of how you identify which options you should be selling at any given time. Now, of course, the way we do it, because these are funds and the capital must always be deployed, there tends to be a little bit less flexibility than even an individual trader might have, where an individual trader, obviously we can't do this in a single stock ETF. It's always going to have the same underlying. But how do you think about it when it comes to identifying, what options you're looking to sell? Because as I understand it, you are principally a premium seller as well, fundamentally.
Yeah, absolutely. I'm a premium seller. Mostly my trading is 99%, no, maybe not 99, let's say 95% naked puts on very well selected stocks. So generally, my choices are based on two different ways to look at the problem. Because on one hand, what I try to do is to not be exercised. So try and find the best strikes to sell. But on the other hand, if I pick the stocks well, meaning with the good fundamentals and in with the possible best timing you can have, um, I am not afraid of getting assigned of the stock. So, it's two different ways to see the same problem. Generally speaking, I'd rather not be exercised if I can. So it's all a matter of probability of not being assigned. Until 8, 9 years ago, when I didn't know Vladimir Furman yet, I used to look at the delta, of course, and because as we all know, it's an approximation of the probability of not being in the money at expiration. And after that, I started using the TradeAI platform and the different probabilistic models, which basically give you a multi-angle perspective on the same phenomenon, which helps you in trying taking the best decisions.
So let me ask you this: as you go about your identifying trades, do you start with a pre-curated list of stocks where you have a typically bullish view or a typically bearish view, or do you actually begin by using the platform to screen for opportunities and then looking for alignment with the opportunities that it has identified with other criteria you might have, be it, like a share price requirement or, your fundamental view of the underlying. So are you looking for it to just spit ideas out and then you pick from those, or do you have a subset of stocks where you're interested in looking for a trade idea and then you go into the system and look for it?
No, the first you mentioned. I start from the lists generated by the platform, which sometimes leads me to trading stocks I have never heard of about before that moment. So basically, I look for the lists of trading ideas generated by the platform, which most of the times are on stocks about to release earnings,
Hmm.
because one of the main let me say one of the pillars of the reliability of probabilistic calculations is when the probability is based on recurring events. Uh, it happens sometimes that the platform is giving you trading ideas on stocks which are not about to release earnings. And so the first question you should ask yourself in those situations is, why is volatility so high? What is generating this kind of expectation in the market operators? So when you know there is nothing, let's say, predictable coming, which is earnings coming every quarter of every year, you should be very suspicious in taking the suggestions provided by the platform, because they could be based on the results of a trial of some some new treatment or something like that, which doesn't happen very often. So in that case, probability is based on nothing that is recurring. So you cannot rely on those probabilistic measurements.
So yeah, maybe you sent us some slides, and maybe we can go through some of these, and you can
Sure.
talk about them, and maybe I'll ask you some questions along the way, um, and particularly if I can get this to advance. One hopes. There we are. Okay, so I'll just let you go through this, and I'll try to keep the slides in tempo with your
Okay.
conversation.
Okay. Basically, the idea of this presentation is to show that the typical approach that most traders have usually in trading options, it, I cannot say it's wrong. Okay, we can say it can be better. Okay, so the idea is, how can we better the approach we can apply in order to try and select the best trades we can find in the options market. So the idea is to start from the way most of the people do the job, which is they take the implied volatility of at the money options, and they calculate the possible price range depending on the square root of time. Okay, you take the annualized volatility and you divide it by the square root of time, and you get to the two extremes of the movement, which, by the way, is based on an assumption of symmetrical distribution of returns, which is not in the real world, of course. But as usual, we tend to use some approximation in our job because it's too difficult to be very precise in this job. So starting from implied volatility and the time to expiration, you know that basically the price range should be between two extremes, which leads in several situations to situations like this. In this slide, I hope that who is following us could read the values, but depending on the normal probability, uh, all these trades here should be 70, 75, 77%, if I'm not mistaken, not losing. But the column in the red rectangle highlight the real result of those trades at expiration, which points out how the relying on the normal probability can be very risky
Hmm.
in most situations. And again, there's another example. We can jump forward.
Hmm.
It's basically the same. And the explanation to the fallacy, I don't know if it's a right word. Sorry if I'm making mistakes. Um, Comes from the fact that even if we know that the normal distribution is an approximation, even if we know that applying a symmetrical bell curve to the distribution of the expected returns is a very strong approximation. And even if we know that the delta of the options, which most of the traders use to estimate the probability of an option not being in the money at expiration, is an approximation of reality, a very few people really understand how much sometimes it can be an approximation of reality. If you move forward to the next slides, I picked 3 examples, which I have to confess I had to look for, because you cannot find examples like this every day. Okay, so I had to go back in time and look for some very peculiar situation. If I remember well, these examples date back to the end of 2021 or the beginning of 2022. But it often happens that you have situations like this. On Tesla, what we can observe is that the right tail is significantly more populated than what you might ever expect, according to any probabilistic model, not just the normal one. And this happens typically, of course, at the end of significantly upgoing trends, like the one we experienced on Tesla in the period of time I observed here. But if you move forward, this is Microsoft. And as we can see, there are some very important differences between the real distribution here is the historical distribution, the distribution of historical returns. And if I remember well, this is a 2 years distribution of 20 days returns or something like that. And as we can see, the left tail of the distribution is almost empty. And this comes again, and even more significantly, in the next slide, which is referred to McDonald's. Look at that. If you based your decisions on the delta of the option, picking, I don't know, the 20 delta option in order to have 80% of probability to be on the right side of the trade, you could even underestimate the real probability on your favor. Because in a case like this, maybe even the 30, 35, or even 40 delta put option would provide a significantly higher probability than what you might ever expect. So all of this is just to say that decisions can be improved, the effectiveness of our trading decisions can be improved moving forward from the normal distribution, from the implied volatility and the delta of the options, including other ways to look at the same problem. And the trade AI approach is based on it's 10, even if you look carefully, it's just 8 in the slide, but it's 10, and I'll explain why very soon. Because starting from the normal probability, which we use, because sometimes it happens that the normal probability is right. Okay, it's not always wrong, of course. It's a model, and like any model, sometimes it's right, sometimes it's wrong. Then we use the historical probability. Then we use the stress test probability. And in terms of historical and stress test, we look back 1 year and 5 years, and so it's 2 pairs of probabilities with under the same label. So
Let me interrupt you at this one, if
yeah,
I
sure,
may, because I think most people who are watching are probably familiar with the concept of a normal probability distribution. Most people
sure.
who are watching are familiar with a historical probability. In fact, actually, the histograms that we showed in these prior pictures are just a
Mhm.
visual depiction of historical returns.
Exactly.
Um, but the stress test probability, that might not necessarily be a concept that I think everybody is familiar with. Maybe you could elaborate on that one just a little bit.
Yeah, sure. And I can tell you that using the platform Trade AI for the last 8 years, my motto has become never fight stress test probability, because when stress test probability says no, it's no. Okay. The concept of the stress test probability is if I use the historical probability to try and describe the typical behavior of an asset, I could, on one hand, have a better description of the typical behavior of that underlying. But on another hand, the risk is to introduce a bias if you're looking back, for instance, at the end of a significantly dropping trend or a significant going up trend. Because at the end of a significant uptrend, like the one on Tesla that comes on this slide here, you could overestimate the probability of positive events and underestimate the probability of negative events. So this could lead you to be overconfident in short selling puts. Okay. And the stress test probability is an elegant, let me say, solution to this problem because it takes into account the magnitude of the movements and not the direction of those movements. So basically, you take the distribution of returns, the historical distribution of returns, you reverse it in respect to the central axis, and then you recalculate all the probabilities. Basically, this is the idea behind the stress test probability.
So interesting. It's very interesting that you mentioned this because, um, one of the stocks that comes to my mind when I think about, first of all, strong uptrends and then very strong downtrends and large volatility, uh, and basically, regime shift is Moderna, right? So
Ah,
Moderna,
Moderna. Okay.
yeah. So Moderna obviously had a remarkable run as a function of the, as we went into the pandemic, and they were arguably the most famous of the vaccine producers, and we had this incredible performance in here, and of course the historical return. If you pick any one of these random spots here or here or here, and you do a look back of the historical return distribution, it's going to exhibit exactly the dynamic that you
Exactly.
suggest. There's a certain amount of volatility, but it's materially skewed to the upside. And then take a look at what happened to the stock. It basically did a complete round trip. And
Yeah.
so the whole dynamic that you had here would essentially be reversed on its way back down. And consequently, the stress test probability is a way to think about the fact that a trend can in fact reverse. It's not saying that
Exactly.
it will, but it recognizes that's a distinct possibility. So
Yeah,
just
it
to
it
give people a
it
sense of
warns
it.
you. It warns you about what could happen, even if it didn't happen so far.
Right, right. Um, okay, so with that stress test probability out of the way, why don't you walk us through some of these other components as well?
Yeah, the earnings probability is basically a historical probability conditional to the periods in which earnings are released. So you just pick the time frames close to the releasing of earnings, and you look at the historical returns only in those periods. So it's a conditional historical probability, basically. The other one, based on events, the implied and historical volatility probability, it is easier to understand if I jump to the RSI probability. The
Hmm.
RSI probability, the stochastic probability, and the percentage price oscillator probability are all based on the same idea, which in case of the RSI is basically I pick the value of the RSI today and I draw a channel plus and minus 5 points, and I look back over the last 6 years, 6 years and a half, usually, every time the RSI was within that channel, if I could take a trade similar to the one I'm trying to take today, how many times I would have been successful on the total. Okay, so let me repeat this. Basically, I look back in time to seek for similar market conditions to the ones we are having today and asking myself, today I want to short sell a put with some strike and some expiration. Okay. If I did the same in the past, every time the market conditions were similar to the current ones, how many times would I have been successful? Okay. It's the classic definition of probability, successful case divided by the total number of observations. So the RSI probability is, let me say, a conversion of the RSI into a probabilistic measurement. Okay, the same applies with the stochastic, the same applies with the percentage price oscillator, and the same applies with implied and historical volatility. The idea is anytime in the last few years when the implied and the historical volatility were in the similar conditions as the current ones, how many times would I have been successful in taking some decisions and how many times I would have been unsuccessful. Okay, so it's basically again an empirical observation of probabilistic measurements of the probability of being successful in taking choices in your options trading.
So the way to think about this then is that obviously it should be important to all options trader. How does the underlying actually behave? How has it been
Exactly.
behaving recently? So that's the first thing. The second thing is how might it behave given the fact that if you are in a trend, that trend, we should invert that. We should take a look
Mhm.
at both what it's doing and an inversion of that, which is sort of what the stress test probability is. Then these other approaches are also taking um, a consistent look back of a relatively sort of easy to calculate, shall we call it, an easy to calculate sort of place in time, a metric that you can use, and then layering that on top of these other approaches, so that essentially you're kind of getting a really wide view. You're kind of taking the circumstances that we're in right now and trying to look at it from a host of different directions. Once it's done this, do you get a single number or do you get a whole bunch of numbers and then you take that information to assemble what the trade idea would be?
No, you get to all the single calculations. And as I said the previous time, the idea is not to try and have the perfect model. The best situation is when all the models basically tell you the same thing. Every time all the different models tell you 92, 93, 95, 97, 95, 93, 92, you can say that basically that should be the correct reading of the probability in your favor. The problem arises when you have 70, 90, 85, 100, 70, 75, okay? Because in that case, not knowing in advance, not having any chance in advance to decide which model will be right at the end, you have a problem because you cannot take a decision. uh,
Yeah. So
I, I,
actually, what I
I
was
don't know how to
going
say that.
to
Sorry.
no, I see what you're saying. You're looking for essentially a lot of green lights
Yeah,
in,
exactly.
you're basically looking that
Yeah.
all the lights ahead of you are
Yeah, that's the
effectively
perfect way
green.
to say that.
Yeah, I mean, one of the what as you spoke, what immediately occurred to me was that we're looking at a Bloomberg technical backtesting and optimization approach. This is not about trading options. This is just about trading direction. But I'm reminded that if you take a look at the best technical indicators over the past year, sometimes you get almost near unanimity, right? In other words, basically everything is saying, it's a go. Sometimes you see everything saying, you probably want to be short this underlying asset, and other times you will find that you get you have a number of very good technical indicators in general, but they end up with very different points of view. So if we take a look right now at Tesla, if we take a look at um, the best performing technical indicators in Tesla, it's not unanimous, but there's near unanimity, right? So only RSI is pointing down. Almost everything else, this is ranked by the best performing over the course of the last year in that direction. I'm just going to pull up for our own amusement. We'll just pick up some of the most popular and heavily traded stocks. And then if I look at something like MicroStrategy, and we should ignore buy and hold because buy and hold is not a technical indicator. Once again, we get near unanimity, but in this case, not unanimous buys, but almost unanimous sells. In fact, it is unanimous. Every one of the top 10 performing technical indicators for MicroStrategy right now is negative because remember, again, buy and hold is not a technical indicator. That's just an investment strategy. that assumes you're just in it to win it forever without discretion. So, what you're looking for essentially with all of these different approaches is to get a situation where they're all pointing to the best of your ability in the same direction, but on a scoring basis, right? So what's sort of the scoring? What's a good score where you kind of get a, because it's not just a simple arrow. It's not just buy or sell. It's a number that you get, right?
Yeah, but sorry, I didn't understand the question.
Oh, so what I'm saying is, when you take a look at what is a threshold for a good number, um, because these are numbers
Oh,
that you
I
get rather
see.
than an
I
arrow.
see.
Yeah, what do
Okay.
you consider a go or a not or a no go typically?
I can tell you again, it depends on what your goals are, because if your goal is not to be exercised, if you're short selling a put, just to say, then you should pick at least 90%. Okay, all the values at least 90%. By the way, I can tell you, I conducted a study a few years ago because I was curious. One day I woke up and I told myself, when, sorry, let me take a step back. Uh, it's basically a problem of trade-off. Okay, how much you want to be safe, how much you're willing to collect in the premiums. But theoretically speaking, if you can get far enough from the current price of the underlying, at some moment you should have all the probabilistic readings equal to 100. Okay, so it's just a matter of the distance. Okay, so I was curious and I asked myself, what if I pick only the options that always have 100% with all the different 10 models calculated by the trade AI platform? I was curious because, of course, the empirical probability could not be 100. So I was curious to see what could it be in real. And along the way, I asked myself, what if all the probabilistic models are above 60? What if they are above 75? What if they are all above 90? And what if they are all 100? And what came out was very interesting because even with the 60% threshold, the empirical rate of success is 84. So
Hmm.
when all the probabilistic models are at least 60, the real win rate is 84%. When it's all 75, you are very close to 90. When it's 90, it's 94, 95. When it's 100, it's 98. Of course, it couldn't be 100.
All right. So
So,
what's interesting about that? That strikes me as I try to think about it intuitively. Why would this be true? To me, this has hints of tolerance stacking, right? That is to say that you when you have one probabilistic model that's giving a certain probability, let's just call it 60. I think that was your earliest example, so the
mhm,
lowest example you examined. One says 60, another one says 60. So all of these different approaches are all saying 60. All of them are looking at the same problem from a slightly different angle.
mhm.
Um, and my guess is that when you have all of those different approaches saying that there is a better chance than not, that there is a conditional probability result of that, which is consistent with the much lower probability of assignment that you were finding when you did the study. How many trades were in the study that you were looking at? How many trades was that?
Not so many. I just picked the six high capitalized stocks from the Dow Jones, and I analyzed the quarterly expirations. So in the end, the study covered around 330 historical trades over 17 years and a half, something like that.
So
Okay.
17 years, 330 trades. So not an enormous sample given the number of
No.
years involved, but well more than 30, let's say. So it
Yeah.
was still a statistically significant
Yeah.
sample, even though it was not as immense. Because I don't think we have the histogram in this one, but we also examined the probability calculations for this approach based on a much higher trade count. So I saw, Vlad had shared some information with me
Yeah.
that covered something like 2 million possible trades, and so and the probability results stacked up very favorably with what actually ended up occurring. So we're talking about the probabilities that the models had calculated ex ante compared with what happened over a very large sample. I mean, 2 million. I think we can safely say that 2 million trades is a very big
It's a very good
sample.
number.
Yeah,
Yes.
that's certainly a good one. So maybe one of the things we could do before we let me see if I can I do this if I can figure out how to close my PowerPoint. I seem to be struggling with that. So what I'm going to do, sorry, I always forget to shut that off. I am going to might actually let me see if I just force that to close. There we go. All right. So I no longer have PowerPoint open. Maybe one of the things we could do is actually walk through. And by the way, I was thinking about the McDonald's distribution in particular. I don't know that I've ever seen a distribution that looked like the one that example you had at McDonald's. That didn't look like the return distribution for stock. It looked like the Burj Khalifa.
I must confess I had to look. I had to look for it. So I had to
Well,
start on the chart, take a very significant upgoing trend, and then select a very good moment to look back a couple years, and then I could find
so
it.
you were just you're just flipping through chart. My friend Carter Worth does this. Every week he's looking at charts and he's trying to identify trade ideas. And what he does is he has charts on a Sunday night. He starts flipping through them that are not labeled because he does not want to be influenced
Hmm.
by the company. But he just flips through charts, and then as soon as he sees one
Okay.
that he thinks is interesting, he sets it to the side. So you're looking at charts, and what you're looking for is a consistent trend with a very narrow sort of band within that trend as the
Hmm.
stock advances, and that's how you can. And then you sort of cut that out, and then said, okay, well, how does that work? That must have taken some time to
Yeah.
identify that.
Yeah. It took some time.
So what I have up on my screen right now is I actually have the application running, maybe or at least components of it, and your iteration of it might be a little bit different than the one I'm running. What would you normally do to sort of start your process when you're using the system?
Yeah.
Is yours in
Basically,
Italian, by the way?
no, I use it in English.
Okay.
Okay. Lately, I've been looking a lot to high probability trades,
Mm-hmm.
okay, mostly, which provides directly a list of very interesting trades you might be willing to take. This is in real time, so usually,
I'm
in a
actually going to
single,
fire this up again because yeah. So
yeah,
you'll actually, if you noticed, Broadcom was at the top, and when I refreshed it, it's now actually in the second place, and the high probability trade that came up at the top of this list, as it happens, is in Galaxy. I'm going to blow this up, so I hope people can see it a little bit better.
yeah, it's a little bit better.
There we are.
Yeah,
So why
yeah,
don't
this
you tell
provides
people what they're looking at here?
Yeah, this is an algorithm of the platform which basically does a screening of the market, looking for the best possible trades you can find at any moment during the day. And usually it's on stocks that are about to release earnings within the next few days. And with this regard, there are some things to point out which we may point out in the next video, because basically just to say very quickly, I usually try and open my trades very close to the event, meaning the same day if the earnings are released after the market, or by the end of the day if they are released the next day before the opening, because otherwise, in opening a trade based on the expectation of the earnings a couple of weeks before or just a couple of days before, you're not just taking the risk of the event, you're also taking the risk of all the rumors, the expectations, and
And
all
the
the previous
market.
movements, yeah, and the market. So
Hmm. So
I'd
this first one
rather.
here I see is Broadcom, and they're going to be announcing next week
Uh-huh.
on the 4th, so next Thursday. So the way you would normally do this, and I'm assuming that is after the close. Let me just confirm that.
Yeah,
So
basically
what you would
I would
normally
wait for
do,
the last moment.
So if indeed Broadcom is, you're looking at, so this is sort of on your radar. So you go through this process daily. You see this thing is on your radar. You say,
Yeah.
okay, Broadcom is an interesting opportunity. Um, it looks like it's bullish going into it. But what you would do is just monitor this day to day, and if we're still seeing it on the morning of September 4th, and
Hmm.
I'm going on to their right now. I'm going on their so the 4th, yes, they're going to be releasing earnings at 5 p.m. Eastern time on the 4th. So you would actually wait until the 4th ostensibly,
Yeah.
and if this still showed up in the high probability trades, then you would affect the trade at that point to try to eliminate basically news that could come in from the side from maybe highly correlated names or from the industry,
Hmm.
and also just the general volatility of the market. So you're trying to be very targeted in your approach. Then I guess the
Yeah.
other advantage is that you don't have long to wait, right? It's a
No.
binary. The earnings come out, the vol
Yeah.
comes in, and you either got it right or wrong.
Yeah. Exactly.
Okay.
Exactly. And basically, I do not just look for the trades highlighted here in the high probability. When I have my list of stocks to follow every day, I have a very important advantage in respect to you guys, because the market here for me opens at 3:30 in the afternoon. So I have
Yeah.
the whole morning to
Hmm.
do all my analysis very easily. And so I have a lot of time to perform my analysis before the market opens.
So the
So
exact opposite of me because I'm on the West Coast in the United
yeah,
States. So the market opens at 6:30 in the morning. We have a trading call at 6 in the morning. Back in my sell side days, our trading calls were, and I'm not kidding, 4:30 in the morning.
wow.
So every day we had a trading call at 4:30 in the morning when I was on the sell side, and typically the expectation when I was on the buy side at the hedge fund was 5 in the morning.
Wow.
So yeah, it was. I rather like the idea that I can eat my lunch, grab a cup of coffee, and still have a couple of hours of work ahead of me before the market actually opens. That's an interesting. That
Yeah.
would be an interesting set of circumstances.
Yeah,
Well,
there's also another very interesting section of the platform which I use on a daily basis, but we will talk about that in the next video. It's the extreme report. Okay,
yeah.
it's a very interesting section.
Yeah, I mean, I guess I could put the, oops, this is the wrong one. It's over here. I could put the extreme report in, I suppose, if we wanted to. I couldn't help myself. I had to go and take a look. I mean, look, you know, many of you are going to be watching this video after these results come out because these are the biggest earnings results we're going to get this quarter for sure.
Yeah,
As we're recording this video, it's going to be coming out after the close, and the market closes in an hour and 10 minutes on August 27th. That's when I'm speaking to you right now.
yeah.
So by the time most of you see this video, the results will be known. I'm looking at this and I'm just a little bit curious to see what was going on there. So just so everybody knows, this is the price trajectory report, and one of the things you're going to see here is that the green boundaries are effectively showing you that's the earnings context, right? That's the movement of
Mhm.
the stock potentially around earnings as compared to what you might normally expect as an upper and a lower range under a non-earnings framework. And this is not going to come as a surprise to anybody that the stock moves more around earnings. Most
Mhm.
stocks do. Some don't move a whole lot more. J.P. Morgan is an example. I think based on the histogram you showed us in McDonald's, that one probably doesn't move a whole lot on earnings, but or at
Yeah,
least it didn't.
there are exceptions. Yeah.
But yeah, so yeah, there are obviously some other things that I think we definitely should and will go through in future videos, including this extreme report,
Yeah.
which you can look at all kinds of things like the changes in open interest, changes in volatility, and I think that's going to be very valuable. But for now, I really appreciate you taking the time to walk us through sort of the underpinning core philosophy of this as an options seller's approach. to try to improve the probability of success and get very handsome returns out of it as well. So Dom, as always, thank you very much for joining us.
Thank
I
you. It's
look
a
for
pleasure.
and hopefully we'll do one of these next week. We've had some technical difficulties of late, which have made this a little bit more challenging for us. Not on his side, not due to his infirmity when we did the previous video, because he's been relaxing in Italy for the vacation, but actually due to some software updates that took place on some of the respective machines, and that really screwed things up. But I think we're kind of working our way through that. So Dominic, as always, great talking to you, really informative, and I'm very much looking forward to the next one. And to all of you who've stuck around and watched this, thank you very much for watching. We'll see you soon.
Thank you.